Between 1989 and 1996, a single brokerage firm on Long Island took roughly $200 million from ordinary investors. Not through a complicated derivatives trade, not through some piece of financial engineering that only a physicist could understand. They did it with telephones, scripts, and a scheme so old it has a name from the days of the carnival. You have probably seen the movie. You have probably never been told how the actual machine underneath it worked. Today we are going to take that machine apart piece by piece, and by the end you will be able to recognize the exact same trick the next time someone tries to run it on you. Because here's the uncomfortable part. The firm is gone, the method is not. It is alive and well right now, just wearing different clothes. Let us start with the man and the firm, because the legend tends to get in the way of the facts. Jordan Belfort began his career at a respected New York brokerage, learning the trade on a real exchange floor. He lost that job, and like a lot of ambitious people who hit a wall, he went looking for an easier game. He found it at the bottom end of the market, selling tiny obscure stocks to people over the phone. Eventually he founded his own firm, Stratton, Oakmont, alongside a partner most people know only as the loud character from the film. At its peak, the firm employed hundreds of brokers and projected the image of a serious Wall Street powerhouse. The image was the product. Brokers were not there to help you build wealth. They were there to move inventory. To understand why the scheme worked, you have to understand how different investing was before the internet. Today, if you want to buy a stock, you open an app, you type in a ticker, you see the price instantly, and you tap a button. The whole thing costs you nothing and takes 10 seconds. In the late 80s and early 90s, none of that existed for the average person. If you wanted to buy a stock, you called a human being a stockbroker, and that broker placed the order for you. If you wanted to know what a stock was even worth, you waited for tomorrow's newspaper, or you called your broker and took their word for it. Information did not flow freely. It flowed through a gatekeeper, and that gatekeeper was paid on commission. That commission structure is the first gear in the machine, so sit with it for a second. Back then, it was completely normal for a single trade to cost as much as 2% of the value of the assets being moved. Half of that went to the broker personally, and half went to the firm. Think about what that incentive does to a human being. The broker does not get paid when you make money. The broker gets paid when you trade. So the rational thing for a broker who cares about their own paycheck more than your retirement is to get you to buy and sell as often as possible. There's even a name for this when it crosses the legal line. It is called churning, generating trades purely to harvest commissions. And no one, not the most famous investor alive, not your broker, not anybody, actually knows whether a given stock is about to go up or down tomorrow. The broker was never selling you certainty. They were selling you activity and charging you for the privilege. Now we add the second gear, and this is the one most people miss. There are two very different worlds a brokerage can operate in. The first is the world of the major exchanges, the kind of public marketplace you have heard of. Companies that want to be listed there have to clear real hurdles. Their financial statements get audited, their management gets background checked. The exchange has rules, and if a firm behaves badly enough to embarrass the exchange can throw them out, which effectively ends the firm's business overnight. That oversight is annoying for honest companies and fatal for dishonest ones. So dishonest operators simply avoided it. They did this by working in the second world, what is called the over-the-counter market. Over-the-counter stocks do not trade through a major exchange and do not carry the same scrutiny. A tiny company that no real bank would touch could walk into a firm like Belfort's and say, "We need to raise money. Can you sell our shares to the public?" And the firm would say, "Sure, but we are taking a large cut of everything we raise." Now ask yourself a simple question. What kind of company is so desperate for cash that it agrees to hand over 10, 15, 20% of the money raised just to find buyers? The answer is almost always a company you should never put a dollar into. Either it is a long shot that cannot get funding anywhere legitimate, or it is an outright fraud looking for fresh money. That is precisely the kind of stock these firms specialized in, because thin, obscure, lightly traded stocks are the easiest ones to manipulate. So now we have all the ingredients. A market with little oversight, stocks so small that a handful of buyers can move the price. An army of brokers paid to push whatever they are told to push. A public that has no easy way to check whether they are being lied to. Put those together and you get the engine at the center of this entire story. It is called a pump and dump, and once you see how it runs, you will never unsee it. Here's the sequence. First, before a single regular customer is called, the insiders quietly accumulate a large block of shares in some tiny company, buying it up cheaply while no one is paying attention. In the world of this firm, the trusted outside accomplices who held these shares had an unflattering nickname, but their job was simple: hold the stock and wait. Second, the order goes out to the sales floor. Every broker in the building starts dialing, pitching this one stock to every client on their list with maximum urgency. The stock is moving, it just doubled. Get in now or you will miss it. Forget the slow part of investing, this is your shot. That wave of buying does exactly what it is designed to do. It pushes the price up. And a rising price is the most persuasive sales tool ever invented, because nothing makes a person want to buy something more than watching its price climb in real time. Third, and this is the cruelest part, once the price has been pumped high enough, the insiders begin to sell. They quietly unload the shares they bought cheaply at the inflated price to all the regular customers who were just talked into buying. And while the insiders are getting out, the firm makes it almost impossible for ordinary clients to get out. Brokers were instructed to not pick up the phone when a customer called to sell. Sell orders would conveniently get lost. The goal was to hold the trapdoor shut just long enough for the insiders to escape. Then, once the insiders were clear and the buying pressure was gone, the price collapsed. The regular investors were left holding a stock worth a fraction of what they paid, with no one left to sell it to. The money did not vanish, it simply moved from the customers' pockets into the insiders' pockets, with the firm taking its cut along the way. That is the whole trick. Manufacture excitement, sell into it, lock the exits, walk away rich. Then the firm got more ambitious and started applying the same logic to companies going public for the first time. When a private company wants to list its shares on a public market, it hires an underwriter to manage the offering, set the price, and make sure all the shares actually sell. Normally that job goes to a serious investment bank, but at its peak, this firm managed to win that underwriting role for real companies. The most famous example is a footwear company you have almost certainly heard of, whose founder went to prison in connection with these schemes. Once the firm controlled the offering, it ran the same playbook on a bigger stage. Insiders loaded up on shares, the sales floor drove the price up at launch, and because the stock was now trading on a public market, it attracted total strangers, people who had never heard of the firm, who simply saw a new stock spiking on its first day and wanted in on the action. That outside buying frenzy gave the insiders an even bigger crowd to sell into. The firm had found a way to combine the lack of oversight that let them manipulate the price with the public trust that a real listing carries. It was, in a dark way, an elegant evolution of the same con. It could not last, and it did not. Regulators eventually caught up. The firm was expelled from the industry in the mid-90s and shut down. Belfort pleaded guilty to securities fraud and money laundering, was ordered to pay restitution running into the hundreds of millions, and served less than 2 years in prison. Many of the people who lost their savings never got close to made whole. And that is the detail the glamorous version always glosses over. For every yacht and every party, there were thousands of ordinary people, retirees, small savers, families, who handed over money they could not afford to lose because a confident voice on the phone told them this was their one big chance. Now here is why none of this is just history. For a while it looked like technology had killed the pump and dump for good. Once anyone could pull up a real-time price and trade for free, the lone broker hyping a worthless stock seemed to lose his power. But the scheme did not die, it migrated. Today the boiler room is a group chat. The brokers are anonymous accounts and online personalities with large followings, and the worthless penny stock has been replaced, in many cases, by obscure cryptocurrencies and meme tokens that anyone can create in an afternoon. The mechanics are identical. Insiders accumulate a token cheaply. They generate a wave of online hype, screenshots of gains, urgency, fear of missing out. New buyers pile in and push the price up. The insiders sell into that buying. The price collapses and the latecomers are left holding nothing. New packaging, same machine. Before we get to how you protect yourself, it is worth killing a comforting myth. The idea that only naive or unintelligent people fall for this, they do not. The victims of these schemes included doctors, lawyers, business owners, people who were sharp in their own fields and assumed that sharpness transferred. It does not, and the scheme is engineered to exploit exactly that confidence. The pressure is calibrated. The voice on the phone is trained to sound like the one person who finally let you in on what the wealthy already know. It flatters you. It creates a private sense of opportunity, and it moves fast enough that you never get the quiet hour you would need to check the facts. Manipulation does not target your intelligence. It targets your emotions, your pride, and above all, your fear of missing out while someone less deserving gets rich. Once you accept that you are a potential target, rather than too clever to be one, you actually become much harder to fool, because you stop trusting the feeling and start checking the facts. So let me leave you with something more useful than a story. Let me give you the warning signs, because the pump and dump survives on exactly the instincts it provokes in you. Be suspicious whenever the central pitch is urgency. Get in now, this is your last chance, the price is moving today. Real long-term investments do not expire at the end of the afternoon. Be suspicious of anything sold primarily on the fact that its price has recently gone up. A rising price is not evidence that something is valuable. It is often just evidence that someone is buying, and the question you should always ask is who and why, and what happens when they stop. Be suspicious of small, obscure, thinly traded assets that suddenly have a chorus of strangers excited about them, because those are the only kind cheap enough to manipulate. And be suspicious anytime the person telling you to buy makes money from you buying rather than from you succeeding. That single question, how does this person actually get paid, would have protected nearly every victim in this entire story. The most important thing to understand is that the firm in the famous movie was never special. The charm was real, the lifestyle was real, but the engine was ancient and simple, and it runs on one thing above all else: the fear that everyone else is getting rich while you sit on the sidelines. The single best defense you have is the boring one. Build wealth slowly in things you understand, on a timeline measured in years, not afternoons. The people who do that are the ones the schemers can never touch, because they are not chasing the thing the scheme is selling. If this helped you see the machine a little more clearly, the best thing you can do is make sure the people you care about can see it too, because the next version of this con is already being built, and the only thing that stops it is knowing exactly what it looks like before it knocks.